Hello, Accounting 203 students. This is Professor Hassey, wrapping up our week number 3, getting us prepared for our class um, on June 30th, but also for quiz number 2, which is due July 6th. And another video will be performed at this week on problem in chapter 4, the closing entries. Today, we're concentrating on adjusting entries. Remember in quiz 1, we understood the accounting equation, putting journal entries, trial balances, posting to the ledger. Now we're going to be doing the adjusting entries, as we've talked about in our introduction video of how to adjust the accounts with certain passages of time. And there's a great problem in the textbook, problem 3.1a, which summarizes all the different types of adjusting entries. And let's take a look at that problem. Before we look at problem 3.1a, let me just make sure and show you where some of the key information is for our class. Again, right now in the quiz and examination section, you have the solutions to quiz number 1, which we talked about, and then quiz number 2, which is due in a week, July 6th. So plenty of time to do quiz number 2. It's due Wednesday, July 6th. This week is week number 3, finishing it up. And again, there's some great information here, understanding these videos about the debits and credits in the accounting cycle, review of the accounting cycle, the steps of the accounting cycle, how to take the trial balance and prepare the various financial statements, the balance sheet, the statement of owner's equity, and the income statement. These are all taken out of your textbook. We'll get into this in another video at the end of this week, the closing of the books process, closing our books, and preparing a post-closing trial balance. A lot of stuff here, but a lot of great material. And then if you're so inclined, some review answers if you want to check work from the textbook and give you solutions of the work, the problem that we're doing today, and on chapter 4. So here are all that information there. So a lot of information available for you. So please make sure you go to your Blackboard and take a look at this information. Also, there's some great information at the end of every chapter in your textbook. It's called summary or cheat sheet, where it goes through examples of journal entries or examples of the work of the chapter. If you ever get confused with looking at problems, if you ever get confused of understanding the material, go to the end of every chapter and look at this. For example, in this, on page 63 of your textbook, at the end of chapter 3, there's examples of prepaid expenses journal entries. There's examples of deferral of revenue adjusting journal entries. There's example of accrued expense journal entries, accrued revenue, the proper way, and this is that slide I have in Blackboard, of recording the financials. So again, this cheat sheet at the end of every chapter is a great way to summarize and look for information that you don't understand in the material for that particular chapter. It's a good thing. Now here's a problem 3-1a at the end of chapter 1 that summarizes all the different types of journal entries and gives you examples of those. Remember, an adjusting entry is to adjust for the accounts for the passage of time, the adjustment of a accrual. It means recording an entry before cash is paid, the recording of expense or the accepting of revenue. It's an adjustment to your accounting records. Well, here are excuse me, great examples of all adjusting entries that could be a study guide for you. And these adjusting entries are in quiz number 2. And it gives the explanation of the entry, and you are to match that up with the appropriate journal here. All right. Well, let's take a look at this. Problem number 1, or entry number 1, interest expense debit, interest payable credit. Where is that over here? Well, that's to record an accrued expense. E, that's to record a accrual expense, letter E, meaning it's an expense that has been occurred, interest, but remains unpaid. It's a liability. We owe the money, but we still have recorded the expense. The passage of time, we owe the money. So we record the expense and we say interest payable because we owe the money and we'll pay at a later date. To record an accrued expense. Let's look at the second one, depreciation expense. Remember, depreciation is recording the cost of a fixed asset over its life. Later on chapters, we'll talk about how that's calculated. In this section, those numbers are given to you. Well, to record a depreciation expense, that is right here, letter I, the depreciation expense. Debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is a contra asset account. And what I mean by contra, it's an asset account with a credit balance, reducing the value of what you're depreciating on the asset balance sheet. Journal entry 3, unearned fees, professional fees earned. That is right here, to record this period's earning of prior unearned revenue. In other words, if any of you have ever had a lawyer, if you ever go to a lawyer and you want them to do some work for you, they'll say, okay, I'll do some work for you, but you have to pay me a retainer. What? I got to pay you in advance before you'd even do anything for me? Yes, that's the nature of the profession. So if you pay a retainer, that is considered unearned revenue for the lawyer, meaning that you're paying for a service that has yet to be provided. Okay, and that entry would be for the lawyer, debit cash, you receive the payment, credit unearned revenue, which is a liability account. Then when the service is provided, when the lawyer provides you the service of being a lawyer, then this is a question or general adjusting entry number 3. You now debit the unearned account, closing that account, and credit revenue, fees earned, because now the service has now been provided. They've provided you the service of being a lawyer where you paid in advance. So that's what that means. Then number 4, insurance expense, prepaid insurance. Well, that is letter G, to record this period's use of a prepaid expense. In other words, we paid something in advance. Now we're paying ourselves in advance. Paying in advance for insurance, like when you get car insurance. When you pay for car insurance, you're paying usually for most policies 6 months in advance. So if you were doing your accounting records, that's considered a prepay. You're paying in advance for a service that's owed you, insurance. So when you make that payment, it's debit prepaid insurance, credit cash, spending the cash. Then as you use up that insurance over the passage of time, you debit insurance expense and reduce the prepaid insurance account by crediting it. So as you incur the use of insurance after the prepaid, this is the entry number 4 or letter G. The next one, number 5, salaries payable. In other words, it looks like here we're now paying a salary expense that we've already accrued, and that is letter B, excuse me, letter C, to record payment of an accrued expense. In other words, we've recorded the liability. Now we're paying the liability by crediting cash and reducing the liability. Letter 6, prepaid rent. Well, here's another one, letter 6. That's H, to record payment of a prepaid expense. All right, we've paid in advance rent. Okay, most rent is usually paid in advance. It's usually paid on the 1st of the month. Well, that's before the month has actually, the rent has been provided for that month. So technically rent is a prepaid. You're paying in advance for the rent for the month on the first day of the month. So debit prepaid, credit cash. It seems kind of confusing, all these adjustments, but it's properly stating the accounting event in terms of either time or the use or the usage of prior entries made. Letter 8, interest receivable, interest revenue. Oop, I skipped one. Did I? Yeah, salaries expense, excuse me, I skipped 7. Salary expense, salaries payable. That is E. Where is it? There we go. to record an accrued expense. In other words, we're recording an expense before it's been paid. Example, it's the last week of a month. So let's say it's the month of June. This week, we're in the month of June. June 27th through 30th is the last week of June. Well, let's say I work this week, or somebody works for me, and I owe them a wage, but the pay date is not going to be until July 1st, Friday. So technically, they're working 4 days in June and 1 day in July. So I would have to make an adjusting entry in June 30th, to record the salary expense for those 4 days and call it salaries payable. Then on July 1, when I actually cut the paycheck, it's like entry number 5. I debit the salaries payable and I credit cash. But on June 30th, I'm recording the accrual right here, the accrued expense, because it's salaries that's been expensed but not paid until the next month. Transaction 8, interest receivable. Again, interest receivable is getting paid in advance, or somebody's owed you receivable. 8, so that is F, to record an accrued revenue. In other words, somebody owes us interest. But as of this transaction, we're recording the interest as revenue, but it remains a receivable, meaning they're not going to pay us until later on, maybe at the end of the loan or whatever. But at the end of this period, it's considered debit interest receivable, asset, credit, revenue. We've incurred the interest, but it remains unpaid. Transaction 9, cash accounts receivable. It looks like somebody's paying us money that they owe us, and that would be letter D, to record a receipt of accrued revenue. We've accrued revenue by putting it into the accounts receivable. Now they're paying us. We receive the money, debit cash, and we wipe out the receivable because they've paid us. Transaction 10. This is to record a receipt of unearned revenue. We've talked about this. If you pay in advance to a lawyer, this is the recording of that. Excuse me, this is the books for the lawyer. Now I've provided the service, they've given me the money, and I record the revenue. Here, they're paying us the receivable of interest, giving us a check for cash and wiping out the receivable. And finally, we prepaid our rent for the month. Now we're wiping out that prepaid and charging it as an expense because the service has been provided. And that is letter G as well. So again, these are all different examples, each one of them. Interest, depreciation, unearned, prepaid, salaries payable, all perfect examples of all the different types of adjusting entries you witness in the accounting cycle. Use this as a cheat sheet, use this as a practice, and we look at these samples of these and all these entries in our quiz number 2, and this will be a perfect guide for that. Remember, adjusting entries are to adjust the books, like at the end of the month, to record accruals, to record receivables, and to make payments of prepaids now being paid. Problem 3.1a at the end of the chapter. Now, problem 3-5 on page 69 of your text at the end of the chapter is a great example of preparing the financial statements. You've done the journal entries, you've done the adjusting entries, you now have an adjusted trial balance. Here's all the accounts. Now your job is to put them into financial statements. Financial statements. Taking the adjusted trial balance and putting the balance sheet accounts in the balance sheet, doing the statement of owner's equity, and also preparing the income statement. And that's an excellent practice of understanding the financial statements, using the trial balance and putting it in the proper statement. That example is practice or given in our week 3 Blackboard, and it's at the end of the chapter 3 in that summary cheat sheet information given at the end of the chapter. And here's what this adjusted trial balance looks like in official financial statements. Okay, here's the income statement. That's the first statement you always should do. And notice there's no balance sheet accounts in this at all. It's just a listing of revenues and a listing of all the expenses from the trial balance. You total up the revenues, you total up all the expenses in the adjusted trial balance, and this company made $87,200 profit for this time period for the year ended. Note the statement heading, very important. Name of the company, what type of financial statement it is, and for what period. That is huge. If you don't put that down, how's the reader going to know what's this for? What's this profit for? So an income statement is just going to the adjusted trial balance and listing all the revenue and expenses. So a reader can interpret, what did we make money? Then you take that $87,200 profit and put it in the statement of owner's equity, meaning we started out the year with $255,800. We add in the net income that we just showed for the year here, and then we take out any withdrawals by the owner right here. That's on the adjusted trial balance, and we come up with our capital balance at the end of the year. Beginning balance, profits, less withdrawals. Then we take this $297,000 and it adds to the balance sheet under the equity section. So you go back to the adjusted trial balance and you list all the asset accounts, all the liability accounts, and then that capital account that we just calculated, and golly, $600,000 of assets equals $600,000 of equity and liability. Those are the three financial statements, and you notice they all work together. The profits go to the equity, go to the balance sheet. And notice how I reported the assets. Automobiles, what we paid for the automobiles, $168,000, that's that balance on the adjusted trial balance, less what we've depreciated thus far. That's the credit balance accumulated depreciation. So we've paid this for our automobiles. We've depreciated this thus far through December 31st. And there's our current balance of our automobiles. Equipment, this is what we paid for it. This is what we've depreciated. And there's the balance in our equipment account. And then naturally land, which is not depreciated. So we list our assets and they should equal our debts, all the different debts. And notice unearned fees is a liability. Somebody's paid us in advance for fees yet to be provided. So here it's just taking all the balance sheet, adjusted trial balance accounts, debits and credits of all the accounts, and putting them in the proper format that tells the reader, did we make money? Income statement. Note the header. What's the equity position of the company? Note the header. And what is the balance sheet? The amount of assets the company owns, the amount of debts that they have, liabilities, and the equity position of the company, and everything is in balance. Pretty cool. Now, what we do in our next video on chapter 4 is to close these accounts. Why do we close the accounts? Because we want to determine in the next year what's going to be our revenues and expenses in the next year. So we have to zero all these out to close the books. The balance sheet accounts are not closed. They are ongoing. They go from year to year. Why? How can we close out cash when we got money in our bank account? How can we close out the automobiles unless if we sell them? Asset accounts and debt accounts go into the next year. But revenue and expenses are always closed at the end of the year. And that's what the closing entries are all about in chapter 4. And we'll discuss that in our next video. So in review, Accounting 203 students, remember our next class is on June 30th. We have no class. We have class on next week. This week on June 30th. Excuse me, I'm losing my touch here. That is week number 4. So we'll see you in class on Thursday evening at 6 o'clock. And at that class, we'll review chapter 4. So then you'll have all the information necessary to do adjusting entries, Chapter 3, closing entries, Chapter 4, to complete quiz number 2. And you can begin quiz number 2 if you'd like, but again, it's not due until next week, July 6th. So we will have a class recording video this Thursday, June 30th. We'll review Chapter 4, closing entries, and put you in good shape to complete your quiz work for this class. So in our class this Thursday evening, June 30th, we'll review Chapter 4 and the closing entries. So you're now ready to prepare quiz number 2, which is due the next week. And then we'll begin our discussion of retail accounting. What's the difference between the accounting for a store that purchases product and then resells it to the customers? It's called retail accounting. And we're going to talk about that also on Thursday. So have a great week. Look forward to seeing you Thursday night. Again, if you cannot make it, let me know. I'll be recording the session. Again, thank you, and we'll see you this Thursday evening. Adios.